Thank you, Heikki, and good morning, everyone. In Heikki's presentation, we went through the strategic choices we have, and now we focus more in detail how these strategic choices have created and will create value. I'll give you some practical examples how our sustainable growth model and scale and synergy have created profitable growth. Also the accelerations what we have put in place in soft goods, direct to consumer, China, USA, digital, how they are shifting our company towards more increasingly interesting areas. And then also the accelerations what we have made in transformation, how it changed our portfolio and the company profile. All these are improving our cash generation, and I'll show you at the end how much we expect them to support to our free cash flow. Starting first with our 4 financial targets, which remain unchanged. What you can see here is each of the target and our performance from the last 12 months, and then also last 5 years. On top line, you can see that it's full green. We have succeeded to maintain mid-single-digit growth over those 2 periods. On profit growth, EBIT growth has been faster than top-line growth, also for 5 years and last 12 months. On balance sheet, it's well below the targeted net debt EBITDA ratio, 2.18 for the last 5 years, and now temporarily peaking up due to the peak acquisitions. And I'll get back to later how we get it back to the historical levels. The only financial target in which we are yellow or green is cash flow generations. And how much we expect that to be improved, I'll get back to later. Then moving on to those examples of value creation, let's start first on top line. Acceleration in soft goods, D2C, China and USA, they have delivered the majority of our compound annual growth from the past 5 years, and they will also continue to do so. Let me explain the chart first, it's pretty complex. Here on the right, you can see our company compound annual growth of 4.7% over the past 5 years. And then we have broken it down to category contributions, channel contributions, and country contributions. Let's start first the categories. So soft goods growth, 11% annual growth over the past 5 years. It's a significant contribution to the group growth of 4.7%. 3.4 out of that 4.7 has been coming from soft goods growth. On channel, D2C, being only 10% of company sales, but with very strong compound annual growth of 22%. Its contribution already is quite significant to our company growth. 1.2 points out of 4.7 is coming a business which is 10% of company sales. And then on countries, same with China, 6% of company sales, but with very strong 29% compound annual growth during the past 5 years. Its contribution to group sales is significant. And then of course USA, $1 billion business for us with over 6% growth from the past 5 years. That's the main contributor to our company sales. Overall, we can say that the areas we have invested in since 2010, the red ones here, are the ones which have delivered majority of the growth. Another way to look whether those investments have yielded back is to compare channel-specific growth. And here you can see that transformation into modern channels drive disproportionate portion of our growth. Also here, let me explain first the chart. You can see here our company growth from the past 12 months, so that in y-axis we have growth index from the last 12 months at the group level 104. And then on x-axis you have share of net sales. You can see that these modern channels, be it own e-commerce, be it own retail, e-tail or click and mortar, they are already 30% of our sales with 17% growth for this period. Fitness being 14% of our company sales at 6% growth. And then the traditional trade, still major part of the company sales index 97. So this proves the case that haven't we invested in those capabilities required in modern channel expansions, our growth would not be at 104, we would be flat or even slightly negative. The modern channels growth is also closely linked to soft goods growth, contributing it heavily. And then also the recent acquisition of Peak Performance, it's nicely further accelerate our growth in those modern channels, especially in D2C. Moving then to gross margin. So I have here 4 examples of our actions we have put in place to improve gross margin. So you can see that in soft goods, category growth and mix-driven margin expansion have delivered over 300 basis point gross margin improvement in the past 5 years, so that our apparel gross margin is at the level of 50%. In ball sport, complexity reduction and acquisition for further scale, Louisville Slugger and EvoShield, the 2 acquisitions we have made in this segment. They have also delivered similar over 300 basis point gross margin improvement. And in ball sport, we are well above 40% gross margin level. In winter sport, as Heikki mentioned, we have started the actions already 2009, 2010, but I'll take only the last 5 years here, and we have continued those production efficiency improvement and complexity reduction in that business. The result is the same as the 2 previous one, so over 300 basis point improvement, and in winter sport, we are well above 45% gross margin. And then the D2C, even within this own channel, we have succeeded to improve gross margin. 300 basis point up, and our own D2C is now at 60% gross margin level. So these 4 are also the main drivers there for our group level gross margin contribution. And what you can see here is that how much they have contributed to our gross margin improvement at group level. Let me explain the slide first. So here you can see how much out of this 230 basis point gross margin improvement over the past 5 years has been coming from categories, and the same 230 basis point contributions by channels. Let's start first with category. So you can see that soft goods alone is the main contributor to our gross margin improvement at the group level. Wilson or ball sport overall, 60 basis point contribution, and winter sport, 50 basis point contribution. Same for channels. So we can say that in B2B channels, we can say that we have done things right. 160 basis point contribution to group level gross margin. But D2C, being only 10% of company sales, having significant contribution to group level gross margin already. Let's stay a while still with gross margin, and I'll be a bit technical now, so bear with me. Here you can see our gross margin improvement during the past 3 years, the blue bubbles here, and also the last 12 months. Also what you can see is US dollar rate and our hedge levels there. The point is that with those proven building blocks I just went through, we have succeeded to mitigate major part of negative FX impacts what we have had. You need to remember that weaker the US dollar is, better it is for our gross margin. And when hedge levels have been coming down, gross margin has followed that, but not with the same pace. We have succeeded to mitigate. What you also can see here is that we now expect some support from FX for 2019. We have already hedged quite significant part of 2019, with improving hedge rates. All the top line growth, all the gross margin improvement I just shared with you have not come from free. So we have continued and we continue investing in those proven building blocks what we have, both for profitability and top line growth. It's well in accordance with our sustainable growth model. So we never let all gross margin gains to flow through to the bottom line, but we invest back to be also in this game for the next, not only this game for the next quarter, but also for the years to come. These slides here show the dark blue line is our annual OPEX growth during the past 5 years. The light blue line is our net sales growth for the same period. And as you can see, also what Heikki mentioned about our significant investment, especially in digital in 2015-16, you can see that OpEx growth was well above top-line growth from 2015 until mid-2017. And since 2017, we have succeeded to break this linearity between top-line growth and OpEx growth. So we balance with our fluidity actions the OpEx growth, what we are getting from investments. So these are the practical examples how we have done profitability, how we have improved profitability, how we have driven also our top-line growth. On top of these, we have also continued to improve our asset efficiency, especially organic asset efficiency. Here you can see on the left, increase in our, or change in our capital employed during the past 5 years. Overall, a bit more than 500 million. At the same time, top-line growth is approximately 700 million. More importantly, organic asset increase here, a bit shy of 140 million, has delivered 450 million top-line growth. So you can see that our organic actions we have put in place for asset efficiency are delivering results. Acquisitions, of course, they are contributing many other things also, scalability, capabilities, and they will further contribute our asset efficiency once fully integrated. More importantly, here on the right, you can see our return on capital employed and our weighted average cost of capital from the past year. So you can see that we have firmly stayed on the value creation track here for the period I have, 5 years. And that's the target. We always continue creating value, keeping our return on capital employed above our weighted average cost of capital. Not only driving faster growth, higher profitability, and then better asset efficiency, these actions we have put in place, strategic choices, acceleration, and the likes, they are also shifting our portfolio towards more attractive areas. Soft goods grow faster than hard goods, and it also reshapes the P&L. We had said a year ago, and then also in the previous year, that our directional P&L structure should be 46-47 for gross margin and 36-37 for OpEx. And here you can see the change, and let me explain the graph. Here is our main financial KPIs from the last 12 months. Net sales, gross profit, EBITDA, EBIT, and then capital employed. You can see that whilst soft goods is a bit shy of 40% of our sales, its share of these main KPIs increasing towards EBIT, so that on EBIT, it's already 60% of company's EBIT. Soft goods share also, or soft goods share growth is also changing our risk profile, lowering our risk profile, and also stabilize our earnings volatility. All in all, we believe that moving more towards those dark blue bars here, we are shifting, or our multiples will be shifted more towards our soft good peers. One important thing, however, is that this kind of plain soft goods, hard good please, is a bit theoretical for us due to the high level of integration. No matter whether it's hard goods, soft goods, we have cross-category integration level very high in go-to-market, in our global operations, in our logistic solutions, and in our shared services. So therefore, you can't consider those being totally separate businesses. On top of this change in our P&L, of course, we are also driving higher return on capital employed in soft goods. And again, let me explain the chart first. Here you can see our EBIT margin split to soft goods and hard goods from the last 12 months. Same for our capital turn or asset turn, resulting to return on capital employed. And as you can see, soft goods is there in its own category, very high level. Whilst soft goods is more working capital intensive than hard goods, we practically have no or very low manufacturing assets in that businesses. And therefore, it's very asset light for us, driving our return on capital employed towards the targeted 20+%. And one important thing is that whilst soft good is structurally more attractive, hard good is still the core of the company. It's 60% of sales, and it continues to improve. No matter whether it's hard goods or soft goods, we always reconfirm our better owner logic for each of the business to ensure they contribute to our value creation model. So we are not only looking for this category change, but business to business, we go through whether they are delivering faster growth or better asset efficiency or better profitability. Our fund allocation also follows the portfolio logic. We always prioritize the transformational drivers, be it soft goods, be it D2C, be it China, and now recently being more and more our modern channel logistic. Moving more towards those modern channels, our own logistic capabilities needs to get updated to the level needed in that business model. We also continue investing in our hard good units. Where the business is in line with portfolio role, good examples are winter sport equipment and ball sport, and or where the current investment program are delivering largely in line with the expectations. And this is what Heikki mentioned about sport instruments and fitness. On cycling, we put now Mavic under strategic review to evaluate whether we are truly the better owner of the assets. And we have engaged now investment bank Centerview to assist us with this process. I said that all these strategic actions, strategic choices, transformation in portfolio, they are also driving our cash generation and balance sheet. And let's take now a couple of slides for that. So whilst our cash flow target has been slightly below the official target of 80%, we have succeeded to fund our organic growth, cash payouts to owner, and share buybacks by our free cash flow. You can see it here on the left, where we have our cash flow from the last 5 years split to sources and uses. So the operating cash flow here covers CapEx, working capital, and payouts and share buybacks, whilst M&A we have funded through increased net debt. On the right, you have our free cash flow net profit curve from the last 5 years. And whilst our 5 years average is level of 68%, the financial target is slightly above. And this is what I mentioned, that we believe that the strategic choices what we have in place for faster growth, better profitability, and higher asset efficiency, they will close the gap. The gap is not very significant from the last 5 years. This gap represents 70 million euros, and we believe that that be quite easily to be closed with the actions we have put in place now when it comes to portfolio. On balance sheet, we have remained within our targets, and now we are focused more on deleveraging. Here you can see our formal net debt EBITDA target of 3 times, and the 5 years average there being well below this 2.2. As I mentioned, now we are slightly peaking up due to peak performance acquisitions there. And we continue going up there now in Q3, because Q3 cash flow is traditionally always negative for Amer Sports, and then it starts going down in Q4. All the acquisitions, for example, peak performance, it's well in line with our funding principles, what we have set for acquisitions. We have said that we are a company of small acquisitions, 100 million every year or 300 million every third year. That has been our M&A range, what we have used, and all the acquisitions made are well within this range. Fund allocation priorities, they will remain largely unchanged, so we continue prioritizing organic growth. We continue prioritizing sustainable, steadily increasing dividend, as we have now done during the past 8 years. At the moment, we are deprioritizing M&A and share buybacks until we have created sufficient headroom there to the maximum targets, like we have done also after previous acquisitions. On long-term funding, we have approximately 200 million long-term funding, scheduled long-term repayments now for the second half of this year, practically for Q4. And then in 2019, as you can see, practically no repayment scheduled for this year. So we have time to focus on cash flow generation and getting balance sheet back to the level it used to be. We have plans in place for refunding, and with those plans, our average interest rate of loan portfolio will change only marginally. In summary, we continue to grow and create value. Our strategy is working, and organic growth drivers remain largely unchanged. We continue our transformation towards fast, sustainable growth, higher profitability, better asset efficiency, having a special focus on soft goods, D2C, and China. On top of that, we have a broader toolbox now, including also strategic choices there, which will change the company profile to a more attractive business model. Thank you.